Hi and welcome to MBA Now. I'm Rob Van Raphorst. Recently, regulators proposed a delay in key banking regulations, which will have a big impact on bank lenders and on the secondary mortgage market as a whole. To talk a little bit about this delay and what it ultimately means for your business, we're joined by Steve O'Connor, MBA's Senior Vice President of Public Policy and Industry Relations. Steve, thanks for being here.
Rob, thanks for having me.
So Steve, this is a big win for MBA. Can you talk a little bit about why we wanted this delay in the regulations?
It was a big win, Rob, and it's important to put it in context. So first of all, you need to understand that Basel is a voluntary regulatory framework. It's a global framework that U.S. banking regulators adopted. It was intended to pertain to systemically important financial institutions, SIFIs, but the U.S. regulators applied it across the marketplace to all depositories. And the capital treatment of mortgage servicing assets and mortgage servicing rights in the accord, we think, are particularly punitive to U.S. institutions, and it's having adverse consequences.
How does this fit into the broader picture of capital treatment for servicing rights?
Right. So first of all, mortgage servicing rights are a very important asset, and they're unique to the U.S. market, and that's one of the challenges that we've had with this capital accord is other institutions globally don't have MSRs the way the U.S. system does. And we think the treatment is too punitive. First of all, effective January 1, the risk weight goes from 100% to 250%. But the bigger issue is the cap that I mentioned, the percentage of mortgage servicing assets that can count toward Tier 1 capital. And what happens is once you hit this 10% cap, dollar for dollar, you've got to deduct every dollar of servicing rights from your regulatory capital. So institutions are either going to have to raise capital, sell servicing rights, curtail servicing, or potentially exit. And this is bad on a number of levels. First of all, it means the institution is going to lose that relationship with the consumer if they have to sell the MSR. Second of all, they'll probably have to sell it at a discount, which will not only hurt them as an institution, but it will depress MSR prices across the marketplace. We think it's bad for consumers because if you have a depressed MSR market, and that's what will happen if you're taking buyers out of the market, it'll mean higher rates for consumers. So we think at the end of the day, it's bad for the borrower, bad for the institution that's having to sell these because of an arbitrary limit, and it's bad for the marketplace.
So what are the next steps now that we got this delay?
So the next steps are that we've been talking to the regulators now for a number of months. We've been urging them to hit the pause. This is something that was in a Treasury report that came out in June. So we're going to continue those conversations. In fact, we're going in to meet with the regulators in a couple of weeks. The important thing is we need to work with our members to develop a solution to this. We need to work with other stakeholders and with the regulators. And those conversations will be able to continue, and more importantly, because of the pause, if it actually goes into effect, it's important to understand it's a proposed pause. We are going to advocate that it go into effect. Then there'll be a second proposed rule, which is how do you change the regulatory treatment of mortgage servicing rights. That's where there's the opportunity to have this dialogue with our members, with other stakeholders, and with the regulators, and trying to find a long-term solution to this issue.
Yeah, as I said, this is a big win for us, and there's a lot that's going to happen going forward, so please come back and let us know.
Great, thank you, Rob.
Be sure to follow us on Twitter at MBA Mortgage and like Mortgage Bankers Association on Facebook and Instagram.